Okay, let's see. All right, everyone, thank you for joining. My name is Andrea. I am the program coordinator from the financial education program. Today we are joined by John Garrigues from Wells Fargo. He has 35 plus years in the banking industry, and he is going to share some great knowledge on talking about credit and how to improve it and look at it and understand it. So thank you, John, for taking your time and joining us today.
Thanks, Andrea, and I appreciate you guys coming. So today, the biggest thing we want you to understand credit. We want you to be able to make plans about credit, and basically this whole deck is about helping you make better decisions. And I think it's really good that I'm gonna move this forward. I think it's really good that you're doing this in college, because you'll graduate from college and start off on life, and everybody wants to go buy their first new car, or and having financial skills set and have good habits before you leave college sets you're preparing for the good job, but then you're also preparing yourself financially to go make smart choices. And it's a good time for you to learn more about credit and to just get your finances in order. And plus, school's expensive, and there are a lot of credit choices you'll have to make in school. Anyway, this is me, John. I guess you're seeing me anyway, but I like to say I've been in consumer credit my whole life. It seems like my whole career. I came right out of my college and went into a management training program at a bank in Salt Lake City, Utah, and then Wells bought that bank 20 years ago. But I started at First Security Bank doing loans in a branch, and credit is something that's kind of dear to me, I guess, because I've done it so long. But it's amazing how people can improve their quality of life if they handle their credit well. So today we're going to talk about credit basics and how credit is recorded, how it's looked at, and then the second topic is debt to income, and that's basically your ability to pay. Do you make enough money to cover that payment? And I would say in my career, this sounds a little negative. I don't like to decline loans, but the loans that I've had to decline in my career, I would bet the largest portion are due to debt to income, people's inability to make a payment, or they want to borrow more than we think they can afford. So that debt, I think that debt to income piece is just as important as the credit piece to help you understand, how much you can afford to pay. And then that we have the 5 C's of credit, which this could sound funny. When I started in banking, we had the 3 C's of credit, so it's gotten more elaborate. but I think that's pretty good. It talks about different things that a bank give you an idea of what banks look at, and then some ways to establish credit, and if you're how to improve your credit, and then just managing your debt. We talk in that section about consolidation loans and things. And if you have student loans, you can go to Andrea, and the financial education program at your own school has great stuff on when to consolidate and not to consolidate. So, and then getting ready to apply. So I'm going to give Andrea a little prop too. I work with a lot of colleges, and your financial education program is like one of the best. Your public service loan forgiveness deck, no one else has. So you're in the right school. If you need help with your finances, get over to their office. I know that sounds, sorry, Andrew, you're laughing, but you didn't expect me to give you a prop, but you guys do a great job. So anyway, let's get back to credit. The first thing that we talk about is a credit report. And I think of it like your transcript at school. It lists all your classes. The same thing with a credit report. It will list all your, what we call a line of credit. If you have a store account at a department store, it'll show up as a line of credit. If you've got a car loan, that'll show up as a line of credit. And just like your classes will all show up on your transcript, anything you have borrowed will show up as a line of credit on your credit report. So I see that and that's a detailed history. And you can pull your own credit. And we talk about that later in the prepare thing of how to pull your own credit and get ready. But it's a good idea to pull your own credit and see what's on your report, because if someone's ever committed fraud, it might show up. You might look and say, "What's that car loan I didn't get?" Or maybe somebody reported something, and maybe you were late 30 days, and they showed up on your credit report, then you got it made it current and they weren't as quick to fix it. So you want to make sure that things are being reported correctly. And then credit score is what you hear about on TV and all that stuff. You Credit Karma, get your credit score for free type of thing, And credit score is what I look, compared to, like, using that same analogy of your transcript. Your credit score is like your GPA. That's how you're doing with that credit. So I look at credit score as a GPA. And it's the same thing with the GPA. The higher the credit score, the better. That was one of a question I had a student ask is a high one better or a low score better? And in golf, the low score is better. In your credit score, you want a higher score. So, this graphic is kind of pretty good at talking about what makes up your credit score. The biggest chunk, 35%, is your payment history. Are you making your payments on time? And they call it paid as agreed. It'll show up on your credit report, paid as agreed. And so that means that if you signed up with a credit card and you're supposed to make a monthly payment, you paid that on time with not late. If you have a car payment and you make your payment every month, it'll show up as paid as agreed. And that's the biggest thing you can do to have a good credit score, is to manage your money and do your payments on time. The next thing is the amount. 30% is the amount owed. And I think what's interesting, what that refers to is like your credit cards. If you have all your credit cards maxed, say you have 3 of them and they have $1,000 balance, limit, and they're all at $1,000, you're not handling them well. That's how they look at those. They want you to keep your balances more like 30% down lower. They don't want you maxing your credit out. And also, if you have too much credit for, if you have too much debt, they can tell that sometimes too. So the amount, the amounts owed, and maybe all of your credit is new, and like your car payment is still pretty full. You've only made a few payments. They look at those types of things, the amount owed. And then, the next thing is the length of your credit history. So students will ask me, well, I've had this credit card that my parents got me before I came here. And it's not the one I like the most, but should I close that one and open another one that gives me better deal? I would keep, if you have a credit card that's a little bit older, they look at the length of your credit history. And you guys are in college, you're young. And so your credit history is not that old. A credit report only goes back 10 years. And so, my first credit card was 40 years ago, a long time ago, because I'm an old guy. But you want to, sometimes you may want to keep that credit card or your piece of credit that's the oldest one, just so that your history is longer, because that affects too. And what they'll see you've been making your payments on time for a longer period of time. And the longer you've been making your payments on time and have kept good credit, the more likely you are to keep doing that. That means that they see that as you having good habits. And so sometimes you might want to keep that older credit card and you can keep it with a 0 balance. You don't have to use it. It'll sit there on your credit report and just says, it'll show as a good line of credit, as long as it's not negative, as long as as long as it's not like delinquent or something. And then 10% is the credit mix and new credit. Credit mix is just they want you to have a car loan, a home loan, and maybe some store accounts or a gas card and some credit cards. If all you had was a whole bunch of credit cards, that would probably be a negative mix. And new credit, if you have a whole bunch of new credit, then you haven't had a chance to prove yourself yet. So I look at that. I helped my son co-sign. I've co-signed for my son on a car loan, and I have good credit, but my credit score immediately dropped 30 points because all of a sudden I had something new that hadn't proven itself. So as my son made his first 3 or 4 payments, my credit score went right back to where it was, because they saw that it was being handled well. But new credit will you can see it immediately, like the next month, if something new pops up. So I like this graphic too. It talks about what is excellent, good, and this is the way we look at it. And we're pretty standard. Wells Fargo is like the biggest consumer bank, but so this is pretty standard for the industry. But it's, we look at the credit score. This is out of 850. Is the highest, and 760. If you've got excellent credit. It doesn't matter whether you're 760 or 800, you're still in the excellent range. And if you go to a car dealer, they'll get you financed and find you the best rate they can get. And for instance, yeah, you can get a better interest rate if you have a better credit score. The middle, that next one, good, you can pretty much get, you can get financing based on your credit. We still look at debt to income and other things. And even someone with excellent credit, if they're over obligated, they could get declined if Andrea, I don't know what your income is, but if you came into a car dealership to buy a Ferrari and it was $250,000 and your payment was going to be, I don't know, $2,500 a month, they would probably say, oh, you've got excellent credit, but you can't afford that payment. So even somebody with excellent credit, if they're doing something that's beyond their reach, the bank could still decline them because of debt to income. And I've that sounds, maybe that's the best way to say it, is beyond their reach. I've had people come in and want to do things that are a little shocking sometimes, and they've got good credit, but they're about to destroy it by doing something they shouldn't. Like if I tried to go buy a Ferrari, they'd decline me. I couldn't afford it. So it's interesting how it works. And if you've got fair credit, you could probably get credit. You might need a cosigner, but you're going to pay a little higher interest rate on things. And if you've got poor credit, you may not be able to get unsecured credit like a credit card, and you may need a cosigner. And sometimes, depending on how things look, sometimes a cosigner won't even help. So some people have to kind of repair what they're doing and get the things they do have in good order to try to bring their score up before they can and kind of rebuild. So, and no credit score isn't a bad thing if you haven't had credit yet. You'll have to develop it. But if you have a student loan will show up on your credit report, and if it's not due yet because you're still in school, it shows up as a positive line of credit because you're handling it as agreed. You don't have to pay it yet, but and it'll just sit there, and that if you got a student loan as a freshman, let's say, that by the time you're out of school, you're going to have 4 years worth of credit, and because of your student loan. So that's not a bad thing either. And then it's always a double-edged sword. If you pay it, it'll look great. If you don't pay it, it will look bad. So credit, that's the thing about credit, is you've got to handle it well. So let's move forward here. Yeah, and this is the part that I think is really important too, very important. We look at gross income, like this before taxes, before they've taken out taxes and your health insurance. You make $100,000 a year, but your paycheck isn't $100,000 a year because they're taking out insurance and taxes. So they use the gross income amount to figure debt to income, which is what you're making prior to all those other deductions. So in this example, the person has 30% debt to income. They have $1,500 in bills. That might be $800 in rent, $700 in car payment, and some other obligations. And when we look at this to approve you for something, we're going to add the payment that you're about to get. If you're looking to buy a car and it has a $500 payment, this person, you would come in and we would add $500 to this. So all of a sudden that would put their debt to income ratio up to 40. With the new obligation. So we look at it, what your debt to income would be after whatever it is you want to do. And it's interesting too, because that when you look at this, that $3,500 looks like, boy, they'd have a lot of extra money, but chances are $2,000 of that's going to taxes and something else. So when that's the thing that's a little deceptive about this too. You know that they could, that doesn't mean they've got that much money out there to just, for discretionary spending. So let's move this forward. And we talk about, it's interesting because, if you've got it below 35%, and Andrea, you can tell me what you guys do. I think most of the people I've talked to as an industry standard on student loans say, don't borrow more than what your payment would be 10% of your expected income. So they like of that, if we go back to this, they like to say that the most you would have in student loans would be 10%. So 10% of that 30 would be your student loans. And if it's bigger than that, then maybe you need to find an extended payment plan, or you can do lots of different things with your student loans to get your payments where you need, or maybe you're just going to have to struggle to get them paid. That's the hard thing. But that's why we try and tell students to not get too much in student loans, because when you graduate, you have things you want to do, like put money in away for retirement, or maybe buy a car, or maybe buy a home. And if you have too much student loan debt, this is where it would hurt you. It would hurt you because you wouldn't be able to get as big a house payment, let's say, or as large car payment, because you have too much student loan payment. And that's why you don't want to over obligate yourself in college and have it hurt you later. But anyway, looking at back to these, if you're at 35%, that's pretty good. You have some room. And typically, these are what typically happens with people. And if you're between 36 and 49, you're probably making your payments. But it's interesting how many people will come in and say they're struggling a little bit. They know they're tight, but they're like, hey, I make all my payments, I can still borrow more. And I would say to somebody who's at 49%, you probably shouldn't be getting, it's not a time to go buy something new and finance it. And if you're over 50, in most cases, we would probably not make that loan. There are times when you might, but for the most part, people, how to say this, when I was first starting out in banking, I'm like this nice guy. I like helping people. I think it's, I want to say yes to everybody. And it was hard for me to decline people when I first started in credit. But then I realized that if I took somebody who was already at 49 and I gave them a car loan, and they ended up adding another payment that put them at 60% debt to income, they would fail. And I would be, sometimes the best thing a lender can do is decline someone, because we understand the debt to income aspect more than a customer does. And a customer will know that they know they're making a payment fine now, but it's always that last little bit that buries you. And so then people would say, why did you bury that person in debt? And I would be criticized for if you go too far with this. So the whole idea with this is to know where you're at, and to kind of know what, if you're looking at something, kind of you could kind of tell, but this is a way to quantify that additional payment would be a good idea or not. And in your planning, this is a good thing to remember. I'll use myself as an example. I wanted to buy a house, but I needed a car, and I knew that I would be buying a house in about a year. And so I bought the cheapest it was a new car, but I bought the cheapest little car I could and got a small payment, so that then a year later I could get a better house payment, because the house is a longer term thing. And it was more important to me to have a nicer house than to have a fancy car. And so I understood this because I was working at the bank at the time. And so I got a very low car payment, planning ahead. And so when you're, just like you can plan with a budget and plan and set your goals, you can set credit goals too, and have that be a part of your budget process. And if you know you're going to be buying a house in another year or two, don't load up on car loans. That happened. I have a mortgage office that's upstairs from me, and the mortgage lenders are always saying how these young couples will have a BMW and then something else like a Suburban, a little pricey cars. And then they go to buy a house and they can't buy the house they want because they have too much debt. And they'll say, but I could qualify for that BMW. How come I can't qualify for the house? And they say, well, because you have the BMW. and I mean, I know that it's, but they're always, just because you can qualify for a fancy car doesn't mean, you might be setting yourself up not to qualify for the house you want, so you need to think ahead. And it's better to learn those lessons in a class and think about it than to go make that mistake and then not be able to get the house you want. Okay, the 5 C's. The first 3 were there when I started. They're kind of just a kind of a cornerstone of credit. The first one is your credit history. How are you making your payments? And it's interesting. I've had a lot of people say to me, but I always pay. I always pay. Well, I've never defaulted. Well, some people, I was shocked when I first started making loans, how people would pay something 30 days late or 60 days late, but they would always pay it. And in their mind, that was fine, but that wasn't paid as agreed. and they weren't paying things on time. And if you're paying late, then the bank has to start sending you letters and make phone calls. And if a lender has to track you down to get your payment, then you're not paying as agreed and you're not going to look as good. So that credit history, it's not just if you're making your payment, it's if you're making your payment on time. And so pay on time every time and you'll be fine. Capacity, that gets back to the debt to income. Can you afford that payment? Collateral is the loan going to, if it's unsecured, like a credit card, the loans are riskier because there's no collateral. And so that's why they have higher interest rates. As loans get collateral on them, then the interest rates go down, because that means if you fail to pay, the bank can repossess or foreclose and get your collateral. And I like to, so that makes the collateral will make a loan less risky because there is something backing it up. But I like to point out that the bank doesn't win if we have to repossess a car. If we repossess a car, we probably lose $4,000 or $5,000 on each car or something. I don't know that exact amount, but it used to be about that when I was doing loans in the branch. And we as a bank, we only really win if our customers succeed. So collateral's great, but sometimes if you want to buy a $10,000 car, but you wanted to finance 12,000, we would say no. We would want you to put a down payment down, because then you've got some skin in the game, and then you're borrowing a more reasonable amount for. If you came in to buy a $10,000 car, the dealer had sold it to you for 15, we would say no. You've paid, that's too much. We're only going to pay this amount. So if a bank won't loan you as much as you want, it might be because that car isn't really worth that much. So sometimes we protect our customers by not loaning more than the value of the property or of the collateral, and that's protecting the bank and protecting our customers. So we really do want people to succeed. And like a home, we never want to repossess a home. Or foreclose. Nobody wins when our customers fail. So we always want to, collateral's great, but we don't, anyway, we want you to succeed. It's part of why we do these classes. And then capital is I like to look at that as, do you have savings? Do you have investments? But for someone like you as a college student, you're not going to have a big stock portfolio already. You're not going to have a house with value backing you up. And capital is, it's for a customer who's been around a long time, we'll look at them and say, oh, they've got all these other investments, they've got these other accounts with us. And so if they struggled, they have stuff to fall back on. Where I relate this to college students, the capital, the 4C, is how do you handle your bank account? And if you go to your bank or your credit union and you apply, I keep using car payments, but let's use a car loan again, and you want to get a car loan, the very first thing they do is they go, oh, Sophia, you bank with us, great. And they look up your bank account, and it says, oh, Sophia's bounced all these checks and isn't handling your money well. And then we go, oh, maybe we better take a closer look at her. If we look at you and we see that you've had your account with us for a while and that you've got some balance, you've got a savings account, and you maybe have a credit card or something, it's interesting. We will look at how you handle your finances, and that, and with our bank, how you handle that relationship too. And so when I think of that capital one, I think of your capital as far as your habits and how you've behaved, or how you've handled your money. So, and that's important too. So yeah, you need to get your ducks in a row. And then conditions are economic conditions. When we had the big recession, when the world kind of blew up in 2009, 2008, I always get mixed up exactly when the world blew up, but it did. And all of a sudden, not one bank in the country would make a new home equity loan, because we knew the values of homes were going down, and a home equity loan is the secondary loan on a house in addition to the mortgage. And so it's a much riskier loan. But literally, I don't think there was a bank in the country that would make a home equity loan during that period of time because of the economic conditions. And I know at the start of the pandemic, a lot of banks were very cautious about lending because people were losing jobs. And so, the conditions are, usually stuff that's out of everyone's control, and Sometimes it'll be something that's happened with interest rates that makes banks tighten up or loosen up their credit standards just a little bit. And that's a little bit out of everybody's control, but that can affect it too. It's right now the conditions. Right now, one of the conditions that's favorable is that interest rates are so low. A lot of people have been able to buy a house that would not have been able to buy a house a few years ago, and so right now, that's why there's such a housing shortage, and so many people are buying houses is because the conditions are favorable for home loans. So in that case, people have homes that it's maybe a good thing, but it's becoming a challenge with having enough houses out there, available. Okay, so to establish credit, that first part that laid the foundation, I already kind of talked about that. Pay your bills on time. You don't think, like your electric bill, let's say you pay, I don't know, Rocky Mountain Power or someone. If you pay that on time every time, it might not show up on your credit report, but if you don't pay it and they have a collection account against you, that will show up on your credit report. So, if someone has to go collect on you, that will be reported on your credit probably. So, pay your bills on time every time, whether it's your power bill, your water bill, the heat bill. I think some landlords might even be able to report if you try to skip out. So, oops, we lost somebody. Oh well. I hope Sophia, stay with us. I hope this is helpful. And open a checking account and use it wisely, and build a savings account. So that's the best way, because then when you go in to start something, you go to where you bank, and they'll have a history with you. And then consider getting a gasoline card or a retail card. A lot of places will give you a retail card if you're making a purchase, and then you handle that card well, and it'll be good credit for you. And then, or you can become an authorized user with a parent or a trusted person, and then apply for a loan with a cosigner. I mean, not everyone has a cosigner, but I've always cosigned to get my sons started. I have 3 boys, 25, 27, and 34. Can you believe that? They're getting old, but I help them get started as a cosigner. And I know a lot of students, will have a parent or grandparent that can help them. And that's not a bad thing. It lets you get a better interest rate too. A good cosigner will help you to be approved and will help you get a better interest rate. So, and then only, once you do get those cards, or, do get some credit, only charge what you can afford to pay back. And like, with my youngest son, especially, he went away to college and we made sure he had a credit card. Because for one thing, if you're going to buy books on Amazon, you need a credit card. And he found that he could get his books a lot cheaper on Amazon. So it saved him money. And I'm not trying to diss a bookstore, but he saved a lot of money on Amazon. And then he also used that and so then we pay that off. And he also used that credit card for emergencies. He blew a tire. I don't know what he did, but he hit a curb or something, and he's an idiot. And I can say that he's my son. He did something stupid and needed to change a tire, and he had the ability to do that, to get a new tire for his car, and so he had it for emergencies. But I wouldn't do things like, or you could even buy your gas. I've talked to students in these sessions who will pay all their gas and pay some of their bills. They have their rent hit their credit card every month, and automatically. So it's automatic. And then they pay the credit card off every month, but they only do that to the amount that they can afford to pay off. So you don't want to charge and have it accrue a balance and get bigger and bigger. You want, if you can, you'd like to use that maybe to pay for your gas for the month and then just pay it off, with your income or with your savings. And so that way you're using the card, but you're not letting it get to too big a balance, or you're paying. If you can pay it off every month, that's great. You're using it, but you're paying it off. Then you're not paying interest, and you're building good credit. And then the bottom one, totally avoid maxing your credit cards if you can. I mean, you may have an emergency, and there's a period of time where I was a little bit paycheck to paycheck when I was first working, and I had a big car bill. And it maxed the credit card almost to get a car repaired because I had to have the car. Well, I was able to get it paid down as fast as I could, but it took a while. But sometimes you can't avoid having a large charge. But if you can, if you could have if I had a little more emergency savings at that time, I would have been able to pull out a savings instead of maxing a credit card. That's another reason to do, but to budget and have some savings. Okay, and then improving your credit. This is where we talk about how to check your credit in the annualcreditreport.com. It's interesting. I really hate, it's interesting. I hate fees. I hate it when students pay fees. Andrea heard me say this in the budgeting thing. Students can get so many things for free and get student discounts. Don't ever pay anyone to do your FAFSA. Don't ever pay anyone for a scholarship search. Do not ever pay anyone to pull your credit. You can do those things yourself and not have to pay a fee. And I really dislike it when companies charge students fees. It's a pet peeve. Anyway, annualcreditreport.com, you can get your credit report for free. And there are 3 major credit reporting agencies, and they'll each give you one for free. So what I did this for a while, and I've kind of got out of the habit. I usually just check it once or twice a year now, but you could get one, and then from one company, 3 or 4 months later, get another free one from the second company, 3 or 4 months later, get a credit report from the third company. And so you could check your credit 3 times a year for free. And that's a really good thing to know what's out there. So if somebody, like say you had a collection account showing from your utility bill, once you pay it off, the utility company is supposed to say paid collection account, and they're supposed to change it so it shows that it's paid off. But they're really quick to throw that on your credit report, but they're really slow sometimes to take it off or show it as paid. So you might have to call that person, and there'll be phone numbers. You might have to call a creditor up and say, "Hey, I paid this. Fix my credit." Or there are ways to get it so it reports accurately. And so that you want to make sure that your credit is reported accurately, and then you need to be responsible and be consistent. And I think the best way, what's always helped me, my biggest bill has usually been my rent or my mortgage, and that always hits at the first of the month. So either if I can get ahead of the game a little, my last paycheck from one month will pay the rent for the next month. But if first, when you're first starting out right out of school, you might have to take your first of the month paycheck and pay your rent or mortgage, and then your second of the month. Most people get paid every 2 weeks or twice a month, and so that's that middle of the month paycheck I would use for my bills, and so that way it kind of balances it out, and so by using that middle of the month one to pay my bills every month, that was my way of being consistent and not missing one. If I for me, I have to have a system and have a little structure around it, or I might forget. And if you forget, then you're going to get a late notice, and it might hurt your credit if you're too late. And so, and then keeping your balances low. If you've got more balances, some high balances, work to get those paid down. Sometimes it's real easy to spend $50 and then make the minimum payment of $35 on your credit and have it gradually creep up. But try to do the opposite, charge a little less and pay a little extra if you've got a balance. And that way you can move that balance lower and eventually pay it off. So, and if you're in a situation where you're struggling, and your credit, stabilize your situation, do a budget, and look at what you kind of have to look at wants and needs. And we talk about coffee, people can spend $6 a day on coffee when, if they made it at home, those little Keurig cup things cost 34 cents at Costco. You can save money or if you meal prep and take your lunch, and you're probably going to eat more healthy, and you're going to spend a whole lot less than if you were to go to the, my youngest son had the worst habits. He would go to he had a meal plan in the dorm that he was paying for, and he would still eat at the Chick-fil-A in the student union every day because he loved it. So he was paying twice for lunch, and we he remedied that by going, when he moved out in the second year of college, then he was on his own budget. He wasn't paying that meal plan. And so then when, but at the same time, he was double paying for lunch for a whole school year, and then wondered why his money was tight. And, and so those are the kind of things that would have been money for him to stabilize his budget and situation. And we need to sometimes look at wants and needs, and maybe tighten up on things that keep the things you need, and maybe say, okay, I'll put that want off if you're struggling to get your payments made, especially, if you're, and we all know when we're struggling. We all know when our credit's tight, we can barely make our bills. So at that point, get back to a budgeting session and stabilize your situations to where you can start paying your credit down. And this is just a good sample of what on a $10,000 loan with a 3-year term, the different interest rates had the difference in payment. And this is a good example. My son Kyle, the middle one, I signed I co-signed with him on his first car, and he paid on it well for 2 years, and then he went in to get a new car. He wanted a truck, and I went in with him, and by then he had good credit, and the dealer, put it in the computer, checked with a bunch of lenders, and told him what a payment was going to be. And I said, put me in there and let me see if I co-sign with him again. And I had excellent credit because I'm a lot older and have a longer history. And so you put my excellent credit on there as a co-signer, and it reduced his payment by $40. It was $45 a month. And so this example can kind of show you how, in that case, I knew he was going to make his payment because he had the two, of who he is. And it was worth it to me to co-sign a second time for my son, even though he didn't need it, to save him $45 a month in interest. And I mean that, we don't want you to pay more interest than you have to ever. And so this is a good example of how, sometimes have a co-signer can make a difference to get you started, or maybe even, it might even be worth it later. So, and if, I don't think you don't always need a co-signer, but and now that Kyle's had his second car loan, and he and his wife actually bought a house, he's probably got excellent credit now. I don't know. I don't see it, but because he's got more history now, he wouldn't need me anyway. I wouldn't add anything because he's already got good credit of his own. So that's part of it. And then managing your debt. This is one of the things that's a little challenging too. It's not always the right thing to consolidate. And but sometimes when people have too much debt and are struggling, a consolidation loan will allow them to put it all under one loan, or you'll do one loan that will pay off some credit cards, or one big student loan that'll pay off all your other student loans. And sometimes it's the right thing to do, and sometimes it's not. If I were going to give you a test on this, I would use the term tangible benefit. Only consolidate if you're going to get a tangible benefit. And that means two things. First, you have to get a lower interest rate. If you're getting a lower interest rate, that has to be there. And then one of these first two things, either pay the debt off faster, or you're going to lower your payment to give you a little payment relief. Maybe the payments are too much for you. So you're either going to so always the interest rate has to be better, and then either pay it off faster or lower your payments. And that gives you tangible benefit. That makes it worth doing. And if you're, so if you're consolidating, you need to do one of those. You need to have tangible benefit, or it's not worth. With student loans, they look at your average rate and put them all together and then round up to the next 1/8%. And so you often, with a student loan, you end up paying more. And but if you're paying it off faster, you're probably going to pay less. You need to be careful. And someone like Andrea, I think you help people all the time with making those choices, don't you? So I would, if you have questions on consolidating your student loans, I would go and talk to Andrea. That's why she's there, and she could help you make a good choice on consolidation. And then on paying off, if say you have several debts and you want to pay them off to manage your money, usually it's best to pay off the one that's the most expensive, that has the highest interest rate. And then also managing your debt, know your limits. If you're struggling now, for heaven's sakes, don't get more, and because you're at your limit. If you're struggling to make your payments, then you're at your limit, and you don't need a debt to income calculation to know you're already tight. So anyway, that's an important thing too. There was something that just popped into my head about that I'm just drawing a blank. I'm sorry. But with that paying the most expensive thing off first, sometimes people will have, say, like 3 credit cards and one of them has a low balance. It's not the most expensive, but it's still fairly expensive. they'll pay that one off first just to feel this sense of accomplishment. Like, I got something paid off. They feel like it's a reward. And then they take the amount they were paying on that and start paying that in addition on the others. So sometimes, sometimes people will pay something that's not their highest interest rate off just to get it out of the way. And then they feel a sense of accomplishment, like I'm reaching that goal of getting out of debt. And I like that psychological idea of knowing you've paid something off. So that there are times when, when you can find out what works best for you. The important thing is to pay more than the minimum payment and get it done. So, and this just talks about the total amount paid, how, someone with good credit and these interest rates and stretching the loan out farther often makes the interest rate higher because the bank is taking a risk longer. And you can see by stretching it out longer, the total amount you pay goes up a lot. And because the interest you're paying your principal off slower, and the interest is accruing over a longer period of time. So car dealers are great at trying to sell you a car based on payment, and they make the payment low by stretching it out farther into a longer term. And that happens with student loans too. If you're at a certain point, you can stretch them out and pay them off over quite a long time, but stretching it out farther means that in the long run, you're going to pay more interest. So that's a management. So you don't want to get a payment that's too big. You want to have a payment that's reasonable, but just stretching it out farther just to have a super low payment might not be the best choice. Or you could get a low payment and then pay extra principal payments too. So that most loans you can pay ahead. Okay, and if you're getting ready to apply, this is this example. It says buying a house, buy it by the time you're 35 and how much you're going to need. This is just kind of what we've already talked about. You need to know what your credit score is, so you know what you're getting into, and make sure your credit report is accurate, and then make sure you kind of know your debt to income. This is just kind of planning ideas. And then you can go out. We've got a smarter credit tool, and then we say talk to a banker if you have a question. And I would say talk to a banker, especially on a house, but you can do it on a car too. You can say, how much can I qualify for? And they'll go in and kind of on a house, they'll pre-qualify you and say, well, you can afford to buy this much house. And then when you're out looking, you know what's in your price range or what price range you can afford. And I think you could do that. You could do that with a car. You could go into your bank or credit union and say, I'm going to go get a car, and I need to know. And then when you're talking to the finance guy, you've got something to compare it with. The finance people usually try and get you the best deal, and sometimes though they get a percentage of it from the lender. And so sometimes they'll send you to, they prefer one lender over the other because they get a higher percentage from that lender. So you should know, you should have a pretty good idea what kind of credit you qualify for before you go in and make a purchase. That's why we talk about getting ready, so that you don't have somebody maybe take advantage of you. Okay, and if you did want to, I have to, because I work at Wells Fargo, I have to give you a Wells Fargo connectivity here. If you did need to, and we have Wells Fargos all around. So you have one close to your campus, I believe, at least in town. Anyway, you can go in person and use a QR code, or call in on the phone, or go online, and we can help get you an appointment to help if you needed to talk to a banker about credit. And that's what we got here. So 45, the credit one's a little longer, I think, Andrea, than the budgeting one, but that's 45 minutes. I hope you. So Sophia,